Imagine starting with a single snowflake, small, ordinary, harmless. Now imagine rolling it across a snowy field, each turn packing more snow, growing heavier, faster. Eventually, you've got something so big it's unstoppable. That's exactly what happens when you stack dividends on top of dividends. Not in risky flavor-of-the-month stocks, but in a portfolio designed to grow income and capital year after year. Today, I'm going to show you the Dividend Snowball Strategy, the same approach that took Harry from frustration to financial clarity. It's built on just 4 proven income machines that combine stability, growth, and monthly cash flow. In a moment, I'll reveal each one and show why, with the latest numbers, this combination could quietly, relentlessly build long-term wealth. Before we dive in, I want to mention that this video is purely for educational purposes and shouldn't be considered personalized financial advice. Always consult with a qualified financial advisor before making any investment decisions. Why most dividend investors get stuck. Most people never get their snowball rolling because they fall into one of 2 traps. Trap number 1, chasing yield alone. Maybe you've seen those ETFs paying 8%, 10%, even 15%. On paper, it sounds incredible. In reality, many of these funds erode their own share price, charge high fees, or invest in riskier assets that can't sustain those payouts. Over time, the total return often lags far behind a balanced dividend approach. Trap number 2, playing it too safe. Others take the opposite route, parking everything in a low-yield index like the S&P 500, which currently yields around 1.2%. Yes, you'll get growth, but your income will be tiny for years, making it harder to reinvest enough to accelerate compounding. The result? Years of investing without seeing the income machine actually build momentum. And when you don't see progress, it's easy to give up. Harry knows the feeling. A few years ago, he was stuck between flashy, high-yield traps and boring, slow-growing index funds. He'd read about compounding, but his dividends felt microscopic, barely enough to buy a cup of coffee each quarter. Meanwhile, the market's ups and downs left him second-guessing his choices. Should he chase higher yields for more income now? Or stick to safer funds and hope growth would pay off decades later? Harry wanted something that would actually work, a way to see his dividends grow steadily, without risking everything. The turning point. Then Harry found the Dividend Snowball Strategy. He started with SCHD as the core. Low cost, 0.06% expense ratio. Strong yield, approximately 3.81% TTM. And a track record of dividend growth averaging approximately 8.6% annually. And if you're new to investing, an ETF, short for Exchange Traded Fund, is basically a basket of different stocks you can buy like one single share. It's one of the simplest ways to instantly own dozens of companies without having to pick them one by one. SCHD holds high-quality names like Coca-Cola, Lockheed Martin, and Texas Instruments, companies with the cash flow to keep paying and raising dividends. To that, he added SDY, a fund that only includes companies with at least 20 years of consecutive dividend increases. Its yield sits around 2.6%, with a 9.6% annualized return over the past 10 years. This became his stability layer. For extra income power, he brought in DVY, yielding about 3.8% and targeting high-yield, large-cap U.S. dividend payers. It provided more immediate cash flow without giving up too much growth potential. Finally, he included Realty Income, known as the monthly dividend company. Yielding roughly 5.62%, it's increased its payout for over 25 consecutive years and sends cash every single month, making the snowball feel alive. Plan. The snowball in action. Harry's method was simple. Set the mix. 50% SCHD, growth plus yield. 25% SDY, stability plus dividend growth. 15% DVY, income boost. 10% Realty Income, monthly payouts. Turn on DRIP. Every time you get a dividend, it's automatically used to buy more shares. No manual reinvestment needed. Those extra shares then earn their own dividends, which buy even more shares, creating a snowball effect without you lifting a finger. Invest monthly. Whether it was $200 or $2,000, the habit mattered more than the amount. Rebalance. Yearly. If one fund grew faster, he'd rebalance to keep the percentages steady, ensuring no single holding dominated. Ignore the noise. Price dips weren't a threat. They were buying opportunities. The first signs of growth. In the first year, Harry's dividends barely felt different from before. But by year 3, the compounding effect started to show. SCHD's quarterly payouts had grown thanks to both higher per-share dividends and owning more shares through DRIP. SDY and DVY were steadily increasing their distributions, while Realty Income's monthly checks created a sense of constant progress. By year 5, the annual income was more than double what it was in year 1, without Harry adding more than his regular contributions. Projecting the snowball, real numbers, over 5, 10, 20, and 30 years. Harry wanted proof, so he ran the numbers using actual historical 10-year annualized returns for each holding. SCHD, 11.9% annualized return, estimate based on inception-to-date CAGR and dividend growth trends. SDY, 9.6%, DVY, 9.8%, Realty Income, 10.0%, with his allocation of 50% SCHD, 25% SDY, 15% DVY, 10% O. The weighted average annual return came out to roughly 10.7%. Here's what happens if you invest $1,000 per month, reinvest all dividends, DRIP, and stick to the plan. Year 5, portfolio value, approximately $77,500. Annual dividends, approximately $3,050 per year, approximately $254 per month. Year 10, portfolio value, approximately $203,000. Annual dividends, approximately $8,100 per year, approximately $675 per month. Year 20, portfolio value, approximately $718,000. Annual dividends, approximately $35,200 per year, approximately $2,933 per month. Year 30, portfolio value, approximately $2.36 million. Annual dividends, approximately $123,000 per year, approximately $10,250 per month. These are not random guesses. These figures are based on verified historical performance and current yields. SCHD approximately 3.81%, SDY approximately 2.6%, DVY approximately 3.8%, O approximately 5.62%. Why this works? The 3 dividend snowball forces. 1. Dividend growth. Even modest yields become powerful when they grow. SCHD's dividend growth has averaged approximately 8.6% annually, while Realty Income has raised its payout 125+ times since listing. 2. Reinvestment. Every payout buys more shares, which produce more dividends, which buy even more shares. Over time, this cycle accelerates. 3. Time. The biggest jumps happen late in the journey. That's why starting early, even with smaller amounts, matters more than chasing a perfect entry point. Managing risk, because snowballs can melt. Harry knew that even the best dividend plan comes with risks. Here's how he protected himself. Sector diversification. SCHD has heavier exposure to energy lately, approximately 21%. So SDY and DVY balance that with more industrials, utilities, and consumer staples. Realty Income brings in commercial real estate across retail, industrial, and agricultural sectors. Low fees. SCHD 0.06%, SDY 0.35%, DVY 0.38%. Realty Income, managed internally, no ETF fee layer. Reinvestment discipline. Dividends were never cashed out early. They were always reinvested until the snowball was large enough to sustain withdrawals. Buying through dips down markets were treated as sale days for future income. Harry's transformation, before versus after. Before, Harry was investing without direction. His dividend income was small and inconsistent, and he had no confidence in his portfolio's ability to sustain him in retirement. With the Dividend Snowball Strategy, Harry had a clear system that balanced yield and growth, an income stream that grew every year without guesswork, peace of mind knowing downturns were opportunities, not threats, future pacing, your life with a fully built snowball. Picture this. It's 20 years from now. You open your brokerage app, not to check prices but to see the month's dividend deposits. Instead of anxiety, you feel calm. This month it's $2,933, enough to cover most people's housing costs or travel budget. By year 30, it's $10,250 a month, without selling a single share. Your snowball is no longer just rolling downhill, it's an avalanche of financial freedom. Why now? Matters more than ever. With interest rates stabilizing and valuations moderating in certain sectors, locking in today's yields could set the stage for even faster compounding. Funds like SCHD, SDY, and DVY are already scooping up strong companies at reasonable prices. Realty Income continues expanding internationally, adding to its long-term cash flow engine. The earlier you start, the more the math works in your favor. Your snowball won't roll itself. Pick your mix: SCHD, SDY, DVY. Automate your contributions. Turn on DRIP. Commit for the long term. The best time to start was yesterday. The next best time is today. If this strategy gave you clarity on building lifetime income, hit the like button. It tells me to make more deep dive videos like this.